That's on. Lovely. Okay. Hi, everyone, and welcome to our CBAM webinar, Portfolio Performance Review and Outlook. We've got Sam with us today to present. We believe that the presentation should take around half an hour, and then obviously leaving some time at the end for any questions that you guys have for Sam. As usual, just pop your questions over into the chat box towards the right-hand side of your screen. I'll pop a little prompt in there as well for you about halfway through the presentation, just to nudge in case there are any questions. It is well worth using, obviously, Sam while he's in front of you. Otherwise, obviously, reach out to him afterwards. There will be a short survey at the end of the presentation as well. So if you do have 5 minutes just to leave some feedback, obviously that would be greatly appreciated. Otherwise, Sam, I will leave that to you.
Thanks, Jess. Good morning, everyone. It's good to see so many attendees on this call today, but then in light of recent market turbulence, that isn't particularly surprising. Obviously, those who are familiar with me, welcome back again. Those who aren't, I am the portfolio co-manager at Cape Berkshire, working alongside Mark. Been within the team now for a number of years now, but I've been the wider AWM group since 2017. Progressively moving up from an analyst to co-manager and taken on a bit more of management roles since the end of 2023. Just some housekeeping bits. This is for information purposes only. It doesn't constitute any form of advice. Cape Berkshire is a point of representative under Ascot Wealth Management, but I assume you already know that. Obviously, Ascot Wealth Management is authorised and regulated by the FCA, and tax legislation could change in the future, though we won't necessarily be going over personal taxation today anyway. Just in terms of what we'll be going over, I'm going to change it up from previous ones, although most of the slides will be performance orientated. Going to open this up quite a bit more for questions and answers. Very wary that there'll be lots of independent thoughts out there and might want to use this opportunity to ask what's going on with the portfolio. Also going to talk a bit about what's our base case for what's happening for the rest of the year. As things stand at the moment, it's relatively positive, with the caveat of we'll see what happens at the end of the 90-day tariff pause there. So I suppose I'll kick off. So first quarter generally was a positive one for us versus benchmark. Fortunately, the last couple of days within March, we had quite a bit of a pullback there, which brought us into negative territory of the majority of portfolios, but the defensive ones holding up very well there. On the P side, we had every single portfolio beating the benchmark, which is obviously what we're seeking to do, by anywhere between 0.25% and around about 0.1% there. I know this seems small in isolation, but if you do that quarter on quarter, of course, builds up and results in good outcomes. The R portfolios, unfortunately, were affected by a particular quirk that happened on the last day of the month, which was rather frustrating. So there was a little bit of a late day market recovery, which happened after the R portfolios do their pricing. So there was quite a rally within the benchmark constituents, but not on the R portfolios, but they got it the day after. But unfortunately, at the end of the quarter, as seen there, it shows that the R portfolios underperformed. But as I'll show in a minute, that was a quirk of a day, and they have generally been performing well. Just looking at what happened over the quarter there, the big stand-up performer, as you will see on the CBAM portfolios, was global gold, returning 31% in a month, which is mad indeed. My personal views on gold at the moment is that we are in an area where we're having people chase chase the rush. I'm sure people on the call will remember what happened in kind of like that 2010 area when everyone was seeking safety, and then you end up with this last flurry of people chasing the run before you get a little bit turn back. We've had since the end of the quarter, not surprisingly, we've had gold go up around about another 10%. What I would say though is that what was interesting is that gold was not a safe haven during the turmoil from the tariff talks. So that was interesting in itself, and I'll talk about that a little bit more in a minute. Europe performed very well, as we had in Germany a new government elected that was very much turned the typical German fiscal prudence into, okay, let's turn on the spending taps, but make sure it's worthwhile. Well, obviously, there's the defense aspect. There's also going to be quite a big amount of spending in infrastructure. Germany is in massive need of good infrastructure spending. Their infrastructure is in not a great shape, to be honest. People may think that German trains run fantastic. They don't. So there's some really good infrastructure spending there, which will certainly help, increase the capacity within the German economy for further growth, which is excellent. European manufacturing, though, still looking a bit nervous at the moment, but the tariff wars might start working out in the favour, a little bit more domestic manufacturing, in certain areas of Europe. But don't treat Europe as a complete wide case at the moment. You probably find more kind of like your Southern European economies have capacity to benefit a little bit better than the Northern European at the moment. Good to see on the P side there, you see in that top five there, two of which are our active holdings, the Man Sterling Corporate Bond Fund, again outperforming its passive equivalent rather nicely. That's been a really nice find for us within the portfolio over the last year or so. And also the Nomura Japan Strategic Value Fund there, coming in at 2.39% on the quarter. That's should be a good one to hold throughout the economic cycle. Nomura are really big Japanese asset manager, and I think that's really important there because whilst an awful lot of asset houses have Japanese offices, Nomura is actually a Japanese company, and obviously that's going to help an awful lot more with the understanding that's going on the ground, very much there. Just looking at the worst performing there, not surprisingly, when looking at the P, it's headed up by 4 out of 5 of them being US orientated funds. Regrettable, but not surprising. We came off of 2025 with rather stretched valuation multiples. Part of the reason why we've included a new fund which we had previously, which is a bit more defensive on that aspect there. There's a couple of pricing quirks there, but the actives are outperforming the benchmark passive there, which is important. And we keep that monitored very closely. It's been a busy quarter for trades, not surprising. So we started off the quarter with a sterling dollar unhedge. They're going 100% unhedged, which we haven't done in quite some time. At that point, dollar was 129 to sterling, with the expectations and wide commentary that it was probably going to be by year end 121. So the move up recently up to 132 has been a bit of a surprise. We have actually added a little bit more back onto the hedge recently, just because of with talks of the UK-US trade deal that would probably be sterling positive. So just helps us get a little bit more over and above on benchmark. Benchmark is typically completely unhedged, so we do this in increments there, and not go put a massive currency position on, because that exposes the portfolios to a lot of active risk there, and currencies can sometimes move in a direction that you're not quite expecting, such as dollar over the last 3 weeks. And then as we go through to early February, there was a bit of an action plan there with regards to managing on the fixed income side of the portfolio, so the bonds, our exposure, whether that being on investment grade or high yield credit or even sovereign bonds, just as sovereign bond yields got to actually higher than where they are right now, even though we've had that sell-off. Just adding on a bit more there onto sovereigns there, in the expectation that the yields come down, which they later did. So capitalize a little bit there on value. And then coming into March, completely sold out of high yield. We saw that high yield credit had got very expensive, and everything was being priced as if it was a perfect environment. And what you find in that situation is, if everything's being priced for everything to be positive, is it doesn't take much to upset that and for you to end up with quite a sell-off. So hence the removal of high yield there, end of February going into March. And then mid-March, as you can see here, going quite a bit more defensive, adding in the JPM US equity income, adding in global infrastructure there, and just a bit of a selling off of US position, and adding into Europe there as well. So that's quite a busy quarter, not surprisingly. It puts us in a rather good position heading into the tariff talks. It seems to be something that a lot of people ignored in the markets. So the fact that we were positioned ready for this, we were actually, I think, probably the most defensive of the portfolios have been during my tenure. So unfortunately, as you know, it's an awful lot of page information for one page. And so I tried to highlight the key bits in general here. So on money markets there, we were over and above benchmark. In the case of portfolio 2, nearly 9% overweight cash money market. So really rather defensive there. And also an overweight there on gilts, favoring gilts to US treasuries there, just in the expectation that the tariff talks would be net treasury negative, as is proven to be the case there. So yeah, very, very defensive coming in to April. How have we done then? Well, the good news is that all portfolios are up versus benchmark. Bad news is all portfolios are down, which isn't surprising. But we've managed to protect quite a bit of the portfolio downfall, which has been nice. If I go to this table here, you see that, for example, R5 has outperformed the internal benchmark by nearly 1% for the month to date. So we've really helped protect those portfolios. But green across the board there versus benchmark. But the worst performing there on a nominal basis is P5, which is obviously rather equity heavy there, selling off 3.75%. But what I think is really important here is the more that you protect portfolios in a downturn, the less hard the portfolios need to work in the good times. As an example case, if a portfolio sold off 50%, as I said, very hypothetical, if a portfolio sells off 50%, it isn't a 50% recovery it needs to get back. It needs to grow 100% to get back to that starting point. So the more that we can help defend these in these situations, the more it benefits portfolios in the long run. Just to illustrate that, this defensiveness and this kind of mindset as to helping protect in downturns, helping the portfolios. If we look at the year to date, we're looking at around about, in the top case there, being P5, we're up nearly 1% versus portfolios there. The only minor negative here is R5 versus the AFI benchmark there, which is an external one, is down 0.03%, so basically flat. But P1, for as an example, is up over 1.25% versus the equivalent AFI benchmark there. So we've helped protect those returns as much as possible. Year to date, unfortunately, we're looking at anything up to down 5.82%. But as mentioned, when you compare this to, say, the internal benchmark is down 6.68, that's less hard that the portfolios need to work on the recovery side there. And looking at across the last year, again, looking at all green, within the P portfolios, in the broad area of around about 2.5% above, 2.5%. P5 a little bit less at 0.46 above, and the Rs have also been performing well. R5 actually versus the AFI benchmark, even though it was flat versus AFI year to date, is outperformed over on the last year by 3.5% there. So we're still in positive despite the pullback we've had over the last 3 or so months. We're still in positive territory for the year on all portfolios. I think that's really important. And the more risk-averse portfolios there showing their defensiveness in these times and doing exactly what they're meant to do. So what do I think is in store for the rest of the year? Okay, I wasn't expecting this to be quite so bad. Jess, is there a way for me to zoom in on these so that things are clearer? Just thank you. Let me just get this report. Oh, that. So let's look at US equity here. We're down towards the bottom in terms of base case. This one thing that those who read my note when we a couple of weeks ago, when we were properly in market panic territory, would have seen that I think the base case for the rest of the years, we're starting to move more now into the narrative of tax cuts and deregulation in the US will start to kick in. The conversations I've been hearing recently is that's actually expected to cut has been brought forward possibly to in 2 months' time. So that could be rather interesting. We have, when we added to the, I think that might be, yeah, when we added 2 positions a few days ago, just closing off at defensiveness, the area of the US that we added to was actually the mid-cap space. And the reason for this is multifold. One is because they're a lot more domestic focused. They tend to be less impacted by tariff wars. So that's obviously a positive there. However, they got into very cheap territory 2 weeks ago. We're looking at around about 13 times earnings, whereas compared to like large cap, at one point a few months ago, you're looking at 25 times earnings. So, you know, they got rather cheap there. 2, they tend to be rather sensitive on things like tax changes. So that's certainly going to be a positive there. And finally, as high yield sold off, high yield debt, mid and small cap tend to be quite sensitive in that area. We expect high yield to become more favorable for the next 3 to 4 months. So that will help bring that mid-cap back into favour. So that should be an area that should help add value into the portfolios. As I said, as high yield sold off quite a bit, it generated a bit of a valuation opportunity. So high yield has come back in. But it's important to add that with our base case being positive there for high yield in terms of good cash flow still within businesses and these tax cuts and deregulation. The unfavorable side possibly on US GDP is that if we start to see a little bit of weakness in the views of the US consumer, and US consumer spending has been really one of the powerhouses behind US GDP growth over the last few years. If we see that move just from in terms of confidence into actually what, the actual sales numbers, this could be a negative situation for US GDP. It could move into a mild recession, perhaps. That isn't our base case scenario, but it's something that we must stay aware of on certain elements of the portfolio, so that as these things start to look a bit more unfavorable, we're quick and ready to move to a more defensive position. At the moment, we're expecting US GDP, real GDP, to slow down to the low 1% kind of range. In part, this is due to a consumer squeeze restart due to tariff wars, but also the effects of, for example, you no doubt have heard about reduced spending on entitlements in the US. These things tend to have a cumulative impact and a delayed impact. So expecting about 4 or 5 months, that kind of area there for macroeconomic data to be really, really important to keep an eye out for. Up to then, I think we're looking okay, but that's the next point where I think we need to be looking into a portfolio about what we are in terms of defensiveness. With regards to UK inflation could move, although the base case is for it to be in the low 3% range by the end of the year. Obviously, I know we had a good print over the last couple of days. Expect some of the base effects to come out of that. But it wouldn't take much for CPI, I think, to maybe stick at 2.6% or even come down a little bit further. It depends on what happens with the I call it tariff wars, so to speak. If the US and China ramps up again, it's tantamount to a trade embargo, although it isn't formally. You've made the goods so expensive that it just isn't worthwhile. In that case, you see trade from China probably pivot more to other economies. So there's possibility of kind of a trade diversion from China resulting in cheaper goods to the UK, which is obviously, from a consumer standpoint, a positive thing. If US GDP, if the tariff wars pick up again, and as I said, the consumer confidence continues to take a bit of a dip, would result in cheaper energy, again helping CPI. Services inflation is by far at the moment the largest component of UK inflation. If we find that that things drop off a little bit quicker than expected, it could easily move down into below 2% there. But it requires quite a few situations, knock-on effects to occur to get into that area. That's why at the moment I think moving up of CPI into the low 3% by the end of the year for UK is more realistic there. One area that, as I said, we added to last month and will add to further is infrastructure. And the reasons for that is it could be a really nice sweet spot in the investment space over the next, starting from last month or for the next 18 months. So all of the tariff wars in the US are obviously our inflation upside risk. It's not companies who pay for inflation at the end of the day. It's the end consumer. So that's going to add to inflation there. And infrastructure, typically for contracts that get assigned to it, and the income that gets assigned to it typically has a written in plus inflation clause written in. So added inflation means that increased earnings there into infrastructure. That's very positive. And not just that, if things spill into a US downturn scenario, would expect US Treasury yields to come down, and that affects the what gets called the discount rate assigned to these earnings in the future, which makes the value of the company now more appealing. So both those two things could come together to be really nice for infrastructure. The infrastructure we're looking at the moment is more US centric. I know obviously there's lots of talk worldwide in terms of increasing infrastructure in Europe, as I mentioned, etc. The thing is, those aren't live today. That benefits construction companies, and not to say they take a long time to build infrastructure, as we all know if you live anywhere near HS2. The infrastructure you want to own is infrastructure that's built now that you can own and operate. That's the interesting bit, and that's the area that we're focusing on very much there. US Treasuries, obviously we have had a situation over the last couple of weeks with US Treasury sell-off, which is due to three reasons. One is the US is kind of upsetting the financial market balance as to the US being a reserve currency and its trustworthiness, and as a result, you've had, particularly from emerging market economies, people trying to move their assets away from being a little bit less US focused. Two has been that the knock-on effect of that has resulted in hedge funds unfortunately have to meet margin calls, in part due to the double whammy of US equity pullback and treasuries, which has meant that they've needed to realize liquid assets. And US Treasury market is pretty much the most liquid market in the world. So it's resulted in a further sell-off there. Third of all, China owns $1 trillion worth of treasuries. Now, I don't have any hard evidence to say that they've been selling off to add pressure, but it wouldn't be surprising. There is data that does come out. It isn't out yet that would suggest this, but it would not be surprising. So that's helped move the US 10-year back up to around about the region it was 2 months ago. But we can see a situation where that sell-off moves another 0.5 percentage point in terms of yield, which on a 10-year is around about 5% capital loss. Further up, what I'd say though is, even though that'd be a 5% capital loss on US Treasuries, two reasons why you still want to hold them. One is the fact that you're getting not far off a 5% yield, income yield, so that kind of nets off those two elements. Two, you need them in there as an insurance element within the portfolio at the moment. If you end up with a downturn in US GDP, we can definitely see the US 10-year moving down into the 3% yield range, which could yield around about a 10% capital growth onto those elements of the portfolio. Very beneficial, really quite important there. Gilts, they are currently cheap versus Treasury. Problem is though, at the moment there's the expectation of this fiscal headroom, which we all keep talking about in the UK, is going to get obliterated, and that in the next full budget, which is October, I think, off the top of my head, there is likely to be further tax rises. Where they're coming from, I'm not sure. We must be pretty close to the point now where maximum taxation and further tax increases actually results in reduced incomes to the exchequer. However, the Treasury is very evident of how sensitive they need to be on this, hence why the spending pledges that have been made in year to date have been offset by spending cuts elsewhere. What could be very beneficial to guilds is if they give themselves a bit more headroom by not making further spending pledges, but picking up a pace of those cuts elsewhere and not making further tax rises. Further tax rises, I actually think, probably be negative, bizarrely, to guilds, just due to the fact that there's not a huge amount of the headroom anymore within the economy to take those on without impacting quite hard UK GDP growth. I think that covers the main points there. Obviously, we'll distribute out these slides after the webinar too, so you can see those tables in a little bit better detail. So yes, going into this month, one thing that we did was that as we had those real pullback there on the sovereign yields, the immediate aftermath of the Treasury announced speech on tariffs, from the States, we closed off part of our gilt overweight that we had. As I said on the earlier slides, going into this month, we had around about 7% overweight of gilts versus benchmark. So as that benefited us very much, we reduced that, took profit there, but also at the same time, sort of an element of the structured product portfolio in 3, 4, and 5 there, just so that we had cash ready to realise, extra cash ready to realise into portfolios as and when the conditions seem more appropriate. Although the low in the markets was 7 working days ago, the problem that I had is that trying to buy into that market proved very difficult because the in the middle of the day volatility was so wide, it's so massive. As you saw, like Monday, Tuesday, Wednesday, you're having 10% moves in the middle of the day. It was a very difficult environment for us to buy into the market. The reason being is because the time that we put in our orders on platforms, it takes around about 2 hours minimum for those trades to actually go through. And when that happened last week, I don't want to be buying into the wrong time of the market, etc. That's why I waited till this week, a bit more sensible time. Volatility's come down quite a bit. Okay, we know what the situation is. Let's put ourselves into the market in the right places there. But we're still sat on, if I go, okay. We're still sat on, here we go. Still sat on quite a lot of cash here. So round about, say, 2%, or in the case of Portfolio 4 there, 3.5% over and above what benchmark is. On cash share. So we still have plenty of dry powder to deploy when we see those opportunities being a bit more certain. And there's certainly areas that we can deploy into. US equity there is slightly positive, but there's further for that to go on. As I mentioned earlier, we can put further into alternative assets, as mentioned. We're still slightly underweight here. I think, though, we wouldn't necessarily be adding to gold. I just think gold, yes, gold can go further, but gold can also come back a long way. I think this is very much an environment where you need to operate sensibly, and you need to be thinking the probability of an outcome times by the upside versus the probability of a downwards outcome and how big is the downside. And at the moment, I think gold is potentially looking more probable to have a downside over the next 12 months there. So not necessarily an area we're going to concentrate on, probably be more on infrastructure there. But that's kind of two of the areas. We can add more into European sovereign debt, which actually might be an interesting area to deploy into in the next few months, just because of with this tax cuts and deregulation talk within the States, would be treasury negative. In a recessionary case, there's a technical factor, which means that the European sovereign debt could outperform other areas. So there's certainly areas of the market we can buy into at the moment. And as I said, we've helped protect from the downside. Let's try and make sure that the portfolio continues to work well in the next 12 months. But as said, we're looking at gilt and treasury yields at over 4.5%. That's a very positive thing for portfolios there, that we're going to have a inverted commas risk-free rate of return on income there at a quite a nice level. Would love to open up the Q&A now, actually. Let's see what questions I have. Yes, Tim, I just noticed that as well when I was looking at the text. I missed off a bit of text on the end there of that table. I'll add that in before Jess sends out in a minute. But please, definitely wanting questions from anyone.
Like Sam mentioned as well, we will be sending the slides out because it's quite a lot of information to get on there to be able to present from. So obviously we'll send those out as well as the recording. And if anything stands out to you with the data, then please do reach out to Sam. He'll be more than willing to have a conversation on them.
Yeah, and of course, I get that, typing questions in on a public space can be a little bit daunting. So feel free to ping me or reply to the email that sends out the slides. And, I really don't mind answering any questions after all. I value your continuing trust in myself and the rest of the team. And definitely more than happy to answer any questions that you might have. See if I've got one coming through. Just wait for that one. What is these moves in exchange rates, pound to dollar? Cable, we've moved to a bit more of a neutral position. So sorry, when I say cable, I mean pound dollar. I see an upside case of 136 possible. As I said, you've got the tax cuts. You've got the UK-US trade talks going on, which seem like they're going to have an outcome. I would certainly add on 1 cent there. I think the thing to move up further, though, is if we end up with quite a pullback on US GDP growth, you could end up with something nudging on 1.4. However, I've still got very much going through my mind at the moment. We had all the commentary at the beginning of the year was saying cable at the end of the year was going to be 121. So unfortunately, the problem is with currency at the moment is that there's a very wide range where I can see things being, and that's before we even go into the whole tariff fallout kind of discussion there. That's why we've gone quite neutral there. We're not wanting to take active risk on something that can change the portfolios by quite a significant amount too much, taking our views more on relative valuations in other areas.
I think we've got another one coming through.
Yeah, Gary, I think you've nailed it. I think from where we are now, I'm quite happy with the portfolio position as is right now. It's quite neutral, especially compared to where we were 6 weeks ago. 6 weeks ago was very defensive. brought that far more neutral position. It's about tweaking, making sure that the active funds that we have in are working, and as they have done, that's one thing that we've done very well for the last 18 months, 2 years. And if we see areas there, then we will realise them. But we're not going to make any rushed large movements. That's about at the moment. It's very much about managing risk. We've got one more. Oh, good question, John. Very good question. That's the multi-trillion-dollar question. So I think it depends where in the world your trade is originating. I can see Chinese renminbi in the more BRICS countries there. Well, there's certainly moves at the moment already within the BRICS countries to make a separate reserve currency. And inevitably, these kind of multilateral negotiations, you end up everyone trying to fight for themselves. But I can see the renminbi winning that one. So I can see, particularly in the BRICS countries, BRICS countries like Brazil, South Africa, India, China, Russia, those countries. I can see them favouring that. I think in the more developed world, I can see euro picking up. But I think dollar's still going to be the world trading currency for quite some time. When you consider, as you know, John, from your past endeavours, contracts still worldwide, whether they be financial or other kind of contracts, all written in USD. And trying to unwind that will take a very long period of time. What would be the scenario causing me to dramatically increase the cash position? I think when we go back to a situation where we see valuation multiples being very stretched, as they were at the end of 2024, they were knocking back into the region of where they were at the end of 2021, which obviously 2022 wasn't favourable partly for that reason. So if that would happen, it certainly would. Again, adding to the cash position would be if we start to see more of a situation again where the markets are pricing for everything to be happy clappy or singing or dancing, that's usually a real sign there for cash needs to come back up here, because it doesn't take much to knock things off its perch, which is what happened 3 weeks ago. So that's certainly, I think, would be the telltale sign there, as in summary, that's something new. So I think that'd be a telltale sign there. If you see things being priced in terms of everything's good and normal, that's when you start increasing the cash position again at the moment. Conversely, going back to where we were 7 working days ago, we were being priced as if we were already in a recession. That's when you would love to be adding money in. Unfortunately, though, the market volatility was so great, we just couldn't rationally do it at the time. We've had to wait until this week. We've got quite a long way, I should add, before the US equities, before they get back into that region again. Actually, when I say about everything fantastic, we're currently working on an S&P 500 forward earnings PE ratio, so and valuation multiple at the moment about 19, which we were looking at the beginning of the year at 25. So you're talking like a 25% upside before we get right back into that situation. If S&P 500 got more down to kind of like 14 kind of area there, that's when you're already kind of talking in a recessionary scenario there. So we're kind of sitting right in the middle of that range at the moment. So that's why I'm comfortable with where we are at the moment and adding into the right areas of the market. I think that's everything, Jess.
Yeah, we haven't had any more come in, so I'm going to pop the survey up now, and we'll leave that up for a couple of minutes. So as mentioned, if you could just take 30 seconds to leave your feedback, obviously that would be appreciated by the team. And we will see you at the next one. But thank you for your time today.
Thanks all.